What if the only thing standing between you and financial freedom was not your salary, not your background, not your credit score, but a single decision you made with $100? And by the end of this video, you'll see how that simple $100 decision could realistically grow into hundreds of thousands of dollars over time, using the same strategy ordinary investors have relied on for decades. That sounds almost too simple to be true, and yet the history of wealth building is filled with stories of people who started with nearly nothing and through patience, strategy, and the right mindset, built lives of genuine financial security. Today, that story could start for you. Here is the uncomfortable truth most people never hear. The average person spends more time researching their next phone to buy than they do planning their entire financial future. We agonize over a $500 purchase and barely give a second thought to the fact that our money, sitting idle in a savings account, is quietly losing value every single year to inflation. Meanwhile, a small group of people, many of whom started with far less than you might think, are watching their net worth grow while they sleep. The best time to plant a tree was 20 years ago. The second best time is right now. This is not a get-rich-quick scheme. This is not a crypto moonshot or a stock tip that promises to triple your money overnight. What this is a clear, honest, beginner-friendly roadmap for turning $100 and a consistent habit into real, lasting wealth. Stick with me through this video, because by the end, you will not just understand the strategies, you will understand the psychology behind why most people never use them, and why those who do end up in a completely different financial reality. Before we dive in, let's establish something important. The principles in this video are not opinions. They are backed by decades of behavioral finance research, compound interest mathematics, and the real-world patterns of ordinary people who built extraordinary wealth. We are going to look at how money actually grows, why human psychology works against us when it comes to investing, and how to rewire those patterns so that your financial decisions serve your future self, not your present impulses. The most powerful insight from wealth psychology research is this: wealth is not primarily about income, it is about behavior. A household earning $50,000 a year that consistently invests 15% of its income will, over 30 years, almost certainly outperform a household earning $150,000 a year that spends everything. The gap between the rich and everyone else is not just a gap in paychecks, it is a gap in habits, thinking, and time in the market. The mindset shift. Let's take a look at the most expensive lie you were told about money. Most of us grew up hearing some version of the same financial advice. Work hard, save money, and one day you will be comfortable. The problem is that saving on its own is not a wealth-building strategy. It is a loss reduction strategy. If your bank account earns 1% interest and inflation runs at 3%, you are effectively losing 2% of your purchasing power every year. That means the $100 you saved today will buy you less in 10 years than it does right now. The mindset shift that separates wealth builders from everyone else is deceptively simple. Okay, now let me ask you something honestly for a moment. If someone handed you $100 today, would you spend it immediately or would you invest it for your future? The wealth builders stopped thinking of money as something to be kept and started thinking of it as something to be put to work. They became owners rather than earners. When you buy shares of a company, you own a piece of that business. When that business grows, you grow with it. You are no longer just trading your time for money. You are making your money earn more money on your behalf. The question is not, can I afford to invest? The question is, can I afford not to? Here is a number that tends to stop people in their tracks. If you had invested just $100 per month starting at age 25 in a broad market index fund averaging an 8% annual return, you would have contributed $48,000 by age 65, but your account would be worth approximately $350,000. You did not earn that extra $300,000 by working harder. You earned it by starting early and staying consistent. That is the magic of compound interest, and it is available to absolutely anyone willing to begin. Now, picture this for a moment. 10 years from now, you open your investment account one morning, and instead of seeing a few $100s sitting there, you see tens of thousands quietly growing in the background of your life. Not because you took huge risks or chased trends, but because you started earlier than most people ever do. So the real question is not whether you have enough to invest. The real question is, what habit are you ready to build starting today? Because wealth rarely begins with a massive check. It begins with a small decision you choose not to neglect. Even $50 a month invested consistently can quietly shift your financial direction. Not because the amount is extraordinary, but because the discipline becomes revolutionary. It is not about the amount, it is about the decision that changes your financial condition. And that brings us to strategy 1, index funds, the wealth builder's secret weapon. Now let's talk about one of the most powerful tools available to a beginner investor. Ironically, it is also one of the least exciting topics you could bring up at a dinner conversation: index funds. An index fund is simply a collection of stocks designed to follow a market index, like the S&P 500, which represents 500 of the largest companies in the United States. So when you invest in an S&P 500 index fund, you are not betting your future on one company's direction. You are investing in the strength of the entire American economic foundation.
Here is what makes this so important for beginners. Most actively managed funds, where professional investors pick individual stocks, fail to outperform the simple index over 10, 15, or 20-year periods. Study after study confirms this. Even the best money managers in the world, with teams of analysts and real-time data, cannot consistently beat the returns of just owning the whole market. So rather than trying to find the winning stocks, you buy them all. The numbers tell a compelling story. The S&P 500 has historically returned an average of roughly 9 to 10% annually over long periods, including crashes, recessions, and bear markets. If you put $100 a month into an S&P 500 index fund at that return rate, here's what your money looks like over time. After 10 years, roughly $18,000. After 20 years, roughly $60,000. After 30 years, approximately $150,000. You contributed only $36,000 of your own money across those 30 years. Compound growth did the rest. When it comes to index fund investing, the structure is simple and beginner-friendly. The learning curve is low, the potential for passive income is high, and the risk is moderate when viewed over the long term. In addition, tax efficiency can be very high when investments are held in tax-advantaged accounts. The practical steps for a beginner are straightforward. First, open a brokerage account. Many modern platforms require no minimum balance and allow you to start investing with as little as $1. Then look for a total market index fund or an S&P 500 index fund with a very low expense ratio, ideally below 0.1% annually. Then automate your contributions. Set it, forget it, and let time do its work. The most dangerous thing you can do with an index fund is check it every day and panic during market dips. Every major market correction in history has been followed by a recovery and new highs. The difference between those who win and those who lose is often just one decision they choose. The winners are not the ones who react to every headline or market report. The winners are the ones who stay patient and stay the course. And that brings us to strategy 2, tax-advantaged accounts, investing on easy mode. Imagine investing your money in a way where the government itself helps you keep more of what you make. Imagine your investments growing year after year while a large portion of your taxes simply disappears. It may sound too good to be true, but it's not a fantasy or gimmick code. That is exactly what tax-advantaged retirement accounts are designed to do. Yet, surprisingly, millions of people are unknowingly leaving thousands of dollars on the table every single year, simply because they never learn how to use this powerful financial mode. In the United States, 2 accounts every beginner investor should know about are the traditional IRA and the Roth IRA. The contribution limit for 2024 is $7,000 per year for individuals under 50. Here is the critical difference. A traditional IRA reduces your taxable income today. You contribute pre-tax dollars and pay taxes when you withdraw in retirement. A Roth IRA works the opposite way. You contribute after-tax dollars, but all your growth is completely tax-free. For younger investors who expect to be in a higher tax bracket later, the Roth IRA is often the better choice. Let's put a number on what that tax advantage means in real life. Imagine you invest $5,000 per year in a Roth IRA from age 25 to 65, earning 8% annually. At retirement, your account would be worth approximately $1.4 million. Every penny of that growth is tax-free when you withdraw it. Compare that to a taxable brokerage account where the same investment might yield around $900,000 after taxes, depending on your bracket. The Roth IRA gave you an extra $500,000 not by earning more, but by keeping more of what you earned. Thinking about whether to use a traditional or Roth IRA? Ask yourself, will you be in a higher or lower tax bracket when you retire? That answer should guide your choice. But before you even decide, check your 401k. If your employer offers a matching contribution, that match is the single highest return on investment anywhere. For example, if they match 50% of your contributions up to 6% of your salary and you earn $50,000 a year, contributing $3,000 instantly earns you $1,500, a 50% return before your investments even begin to grow. Not contributing enough to capture the full match? You're leaving free money on the table. Now, let's dive into strategy 3, dividend investing, getting paid while you sleep. Here is a concept that fundamentally changes the way many people think about money for the first time. What if your portfolio sent you a check every 3 months just for owning shares in a company? That is the essence of dividend investing, and it is one of the most psychologically satisfying forms of investing because you get tangible, regular feedback that your money is working. Dividend stocks are shares in companies that distribute a portion of their profits to shareholders on a regular basis. Think of well-established businesses in sectors like consumer staples, utilities, healthcare, or financials, companies that generate reliable cash flow year after year. Some of these companies have paid and raised their dividends consistently for 25 years or more, earning them the title of dividend aristocrats. Here's how the numbers can add up even from a modest start. Suppose you invest $200 per month into a dividend-focused index fund or ETF yielding 3% annually. In the first year, you might receive around $36 in dividends on a $1,500 average balance. That doesn't sound like much, but here's the compounding effect. If you reinvest those dividends, which most brokerage accounts can do automatically, you now own more shares. Those additional shares generate more dividends next quarter. That cycle, repeated over decades, creates what investors call a dividend snowball. Now, let's look at what this strategy really offers. First, passive income potential. Over time, this can grow from moderate to very powerful, especially if you reinvest your dividends and let compounding do the heavy lifting. Second, risk level. Compared with many high-growth stocks, the risk here is generally lower because these companies tend to be more stable and financially established. Third, the learning curve. It's moderate. You don't need to be a Wall Street expert to start, but understanding a few basic principles can make a big difference. And finally, tax efficiency. Many of these dividends qualify for lower tax rates, meaning the government takes less and you keep more of what your money earns. And when you combine steady income, reasonable risk, and favorable taxes, you begin to see why so many long-term investors quietly rely on this strategy to build wealth. The key distinction here is between short-term excitement and long-term wealth. Dividend investing won't make you rich next year, but a well-constructed dividend portfolio built consistently over 15 to 20 years can eventually generate enough passive income to cover your monthly expenses, rent, groceries, utilities. That is the definition of financial freedom, having more passive income than you have expenses. The investment is buying you back your time. Let's take a look at strategy 4, REITs, real estate investing without the landlord headaches. When most people think about real estate investing, they picture buying a rental property, dealing with tenants, fixing leaky pipes at midnight, and needing a large down payment to even get started. That model of real estate investing is real and it works, but it's not accessible to most beginners with $100. However, there is another way. Real estate investment trusts, commonly known as REITs, allow you to invest in real estate the same way you invest in stocks, with as little as $1 through any standard brokerage account. A REIT is a company that owns income-producing real estate, whether that's apartment complexes, office buildings, shopping centers, data centers, hospitals, or warehouses. By law in the United States, REITs must distribute at least 90% of their taxable income as dividends to shareholders. That means REITs tend to offer some of the highest dividend yields in the market. Consider someone who began investing $150 a month into a diversified REIT index fund 5 years ago. Assuming a total return, including dividends, around 9% annually, that investor would now hold a portfolio worth approximately $11,000, having contributed only $9,000 of their own money. More importantly, they would be receiving quarterly dividend income, passive income from real estate, without ever owning a single brick.
What would happen if your investment portfolio started paying for your rent every month? That is the long-term vision of building a REIT-based income stream. The risk consideration with REITs is that they are more sensitive to interest rate changes than some other asset classes. When interest rates rise, REITs can experience price declines in the short term. However, over longer time horizons, their income generation and inflation hedging properties tend to smooth out those fluctuations. For a beginner building a diversified portfolio, allocating a portion, perhaps 10 to 15% of your investments to REITs, can provide both income and inflation protection. Now, strategy 5, which is investing in yourself. This is the highest return asset. Every conversation about investing eventually circles back to this often overlooked asset class. You. Your skills, your knowledge, and your earning capacity are the engine that funds every other investment. Warren Buffett has said repeatedly that the best investment you can ever make is in yourself. No one can tax it, inflate it away, or take it from you. This is especially powerful for younger investors. If you spend $100 on a course that teaches you a skill that leads to a promotion or a side income stream, that return on investment can dwarf anything the stock market offers in the short term. A freelance skill that generates an extra $300 a month is worth $3,600 a year, an effective 3,600% annual return on a $100 investment. That income, redirected into index funds or retirement accounts, compounds for decades. The psychological dimension here is equally important. When you invest in your own education and capability, you build confidence. You develop what researchers call financial self-efficacy, the belief that you are capable of making smart financial decisions. That belief changes your behavior. People with high financial self-efficacy are more likely to save, invest, and stay calm during market volatility. They are less likely to make panic-driven decisions that undermine their long-term returns. The investment in yourself is both financial and psychological, and both kinds of returns compound. The Wealth Building Blueprint: What to do starting today. Let us bring everything together. Over the past few minutes, we have covered 5 strategies for building real wealth as a beginner investor. First, index funds give you diversified exposure to the entire stock market with minimal effort and low cost, leveraging the long-term upward trajectory of the economy. Second, tax-advantaged accounts like Roth IRAs and 401ks protect your gains from taxation and, in the case of employer matching, offer instant returns that no other investment can match. Third, dividend investing builds a passive income stream that compounds over time, gradually replacing your need to trade time for money. Fourth, REITs open the door to real estate income without the capital requirements of property ownership. And fifth, perhaps most powerfully, investing in yourself accelerates your earnings and builds the psychological foundation for every financial decision you will ever make. The action plan is simple. Step 1. Open a brokerage account this week if you do not already have one.
Many of the most respected platforms charge no fees and allow you to start with as little as $1. Step 2, set up an automatic monthly contribution, even if it's just $50. Automation removes the emotional friction that causes most people to delay or quit. Step 3, invest in a broad market index fund first before adding any other strategy. Build the foundation before the additions. Step 4, if your employer offers a 401k match, contribute at least enough to capture the full match immediately. And Step 5, commit to learning one new concept about investing every single week. Not because you need to become an expert, but because understanding grows confidence, and confidence leads to consistency. You do not need to be wealthy to start investing. You need to start investing to become wealthy. Here's the thing about money that the wealthy understand and that the rest of us are never explicitly taught. The barrier to entry is not financial, it's psychological. The fear of starting, the fear of losing, the fear of looking foolish, these are the real obstacles. Every strategy in this video is accessible to someone with $100 and the willingness to begin. The question is whether you are willing to act today rather than waiting for conditions to be perfect, because the perfect conditions will never arrive. The only conditions that matter are the ones in front of you right now. I want to leave you with 2 questions that I genuinely hope you will think about and share in the comments below. First, which strategy are you most excited to try? Is it the simplicity of index funds, the tax advantages of the Roth IRA, the passive income potential of dividends or REITs, or the compounding power of investing in your own skills? And second, what's one concrete change you will make to your financial habits this week? Not next month, not when things settle down, this week. Even the smallest action taken today sets a new trajectory in motion. Before you leave, I'm curious about something. If you had $100 to invest today, where would you put it first? Index funds, dividend stocks, real estate through REITs, or investing in your own skills? Drop your answer in the comments section below. Are you brand new to investing? Have you already taken your first step? What's holding you back, or what gave you the confidence to begin? Your answer might also inspire someone else who is thinking about taking their very first step. Your comment might be the thing that gives someone else the permission they need to get started. Share your journey. Drop your answer in the comments. Let's build wealth together, starting with $100.